Welcome to the Stock Market Palantir. Today we are going to talk about USRW and more broadly its parent company, USA Rare Earth, or USAR. We're looking at the just dramatic, almost unprecedented volatility we've seen.
It's been a complete collapse. I mean, from a 52-week high near $44 all the way down to the $12 or $13 range we're seeing now in late November 2025. It's stunning.
It is, and it really represents a perfect storm. You have this huge geopolitical narrative, the whole critical minerals supercycle, smashing right into the very complex and frankly unforgiving technical mechanics of a de-SPAC restructuring.
And the mandatory warrant redemption, you can't forget that part. That's the real trigger.
Exactly. Which brings us to the core of our discussion today. The central question is this. Is this precipitous decline in USAR stock primarily a rational, almost predictable market adjustment? Is it driven by capital structure mechanics, warrant redemption, dilution, a fundamental re-rating?
Or is it something else? Is it fundamentally driven by a dysfunctional market structure? One where microstructure complexity and arbitrage loops are being systematically exploited. And I'm going to argue it's absolutely the latter.
And I'll be arguing that while those structural elements, they add friction, they add noise, the core movement is the direct mathematical consequence of dilution and disciplined hedging. It's painful, yes, but it is, at its heart, a rational repricing.
Well, let's get into it.
So my core thesis is built on what I call dilution gravity. The stock's repricing is just the logical and, I'd say, inevitable result of its capital structure adjusting. When USAR announced the mandatory redemption of its public warrants, it was basically a guarantee that a huge amount of new common stock was about to be created.
The floodgates opened.
They did. And that triggered a massive, and I mean massive, risk-free arbitrage opportunity. Professional traders can lock in guaranteed profit. They do it by shorting the common stock, selling USAR, while simultaneously exercising the warrants at that fixed $11.50 strike price. So that $11.50 price becomes this unyielding gravitational anchor, just pulling the stock down. And on top of that, you got a reality check from their earnings.
The Q3 report.
Right. The Q3 2025 earnings showed a cash burn that was just way worse than anyone expected. A loss per share of negative 25 cents versus Wall Street expecting maybe negative 6 cents. In this interest rate environment, that kind of miss demands a risk re-rating. So the price drop isn't a random collapse. It's just the math of massive dilution hitting some newfound fundamental risk.
Okay, I acknowledge the power of that 1150 anchor. The arbitrage is a huge, huge supplier of shares. No one's debating that. But I think you're focusing on why the shares are being supplied, and I'm focused on how they're being transacted and the efficiency of that process. The extreme volatility, the clear lack of efficient price discovery. To me, that suggests the problem is structural. I mean, just look at the data. We're consistently seeing a high level of off-exchange trading, regularly over 45% of the total volume.
Well, that's often because you've got large block trades, or it's just retail orders being internalized by the big wholesalers.
That's a partial truth, a very partial truth. While it does facilitate that block hedging, that off-exchange environment, the dark pools, it's also fertile ground for toxic activity. I'm talking specifically about latency arbitrage. For listeners who don't know, this is where high-frequency trading firms use their speed advantage, we're talking microseconds, to exploit tiny price differences between all these fragmented trading venues. They pick off stale quotes in the dark pools before the price can update everywhere. This predatory behavior literally sucks liquidity out of the market. And crucially, it accelerates the price movement way beyond what simple arbitrage hedging would require. It turns a rational adjustment into a destructive cascade.
That's a fair point on the toxicity, but you can't ignore the confusion baked into the structure itself.
Exactly my point. We also have to talk about the behavioral element here, which is a direct result of the de-SPAC mechanism. The specifics of the deal, that 0.204 exchange ratio, the retroactive recasting of the capital history, it creates a financial structure that is almost impenetrable for a regular retail investor. It looks and feels like a reverse split or a massive dilution event they just can't quantify. And this confusion leads to erratic emotional behavior, loss aversion. You get retail holders who refuse to sell at a loss, creating this this deep layer of stale overhead supply that then caps any rally. The market isn't just dealing with delusion, it's grappling with weaponized complexity.
Okay. That's a good way to connect the structural issues to behavioral outcomes. But let's go back to the engine of the drop. I still maintain the arbitrage selling is that engine of volatility. That short interest, what is it, around 9.1 million shares in the last report? That is simply the institutional insurance policy. It's the required hedge for the trade. The selling is unavoidable and, I'd argue, proportional to the dilution risk. It explains the fast drop from $20 down into the low teens.
I'm sorry, I just don't buy that it's benign or inevitable in its current form. We agree the short interest is the hedging tool, but that high off-exchange volume, that 45% figure, that is the toxic exhaust of the arbitrage machine. If price discovery is supposed to happen on lit, open markets, why is almost half the volume happening in the dark? This fragmentation allows HFTs to just scalp liquidity all day long. The volume itself compromises the integrity of the price discovery process, ensuring the stock drops faster and further than it should. The 1150 anchor is real, but the environment where the ship is sinking is, well, it's structurally polluted.
Okay, I take your point. Fragmentation is a reality of the modern market, and yes, it absolutely introduces inefficiencies. But we have to be precise here. While these alternative trading systems, these ATSs and TRFs, lack a visible order book like the NASDAQ, they are still regulated venues. The trades get reported instantly, and more importantly, the fundamental math doesn't change. The stock price has to converge toward the 1150 exercise price because institutional capital will just keep selling until that risk-free profit is gone. The venue doesn't change the gravitational constant.
There's a compelling argument, but I think you're underestimating how behavioral factors just supercharge this whole dynamic. You brought up the Q3 miss, a valid point. But that fundamental adjustment is totally clouded by the behavior around USR. I mean, retail investors see this stock as more than a company. It's a strategic asset, a geopolitical hedge. They call it patriotic capital. Their demand is highly inelastic to normal metrics like PE. And that inelastic, narrative-driven demand creates the exact kind of exploitable liquidity pockets that algorithmic traders live for.
I agree, the narrative provides a sentiment floor, which is probably why we didn't see a total panic sell-off way below that 1150 anchor. But institutional capital can't just bet on geopolitics forever. It has to bet on execution. The capital intensity, the sheer difficulty of building a mine-to-magnet supply chain, that, combined with the dilution, those are real financial variables. And right now, the market is rewarding disciplined financial analysis over geopolitical passion.
And speaking of that calculation versus narrative, we should talk about the Russell 2000 inclusion. A lot of retail holders see that as a huge catalyst, a pump that's coming.
And that is a perfect case study in the danger of betting on narrative. Yes, the passive index buying for the Russell, which is effective December 22nd, it will create some artificial demand. But the hedge funds are already front-running it. They've already done the math, they bought shares weeks ago, and now they are just waiting to unload those shares right into that passive buying. And in USAR's unique case, that passive index bid is going to collide head-on with the massive supply from the warrant exercises. The funds know that the sheer volume of new shares coming in at an 1150 basis will likely neutralize or even swamp that index bid. The pump becomes exit liquidity for smart money.
This brings us to maybe the most chaotic element, and one that I think challenges your purely rational model: settlement risk. Our research shows persistent, and I mean significant, fails to deliver FTDs in USAR stock during this whole period.
Well, FTDs are pretty standard in these situations. They're an administrative feature of huge capital structure changes, especially warrant conversions. An arbitrager sells the stock short to lock in the spread, right? But the physical delivery of the new share from the transfer agent, that takes days, sometimes weeks. So when the settlement date arrives, the short seller technically fails to deliver because the share hasn't even been created yet. It's usually just a timing delay that clears up.
See, I'd push back on calling them purely administrative. Yes, they happen, but their persistence and their magnitude are what introduce this non-linear, chaotic risk. When these FTDs persist, the stock gets placed on the Regulation SHO threshold list. This means that if those failures continue for 13 consecutive settlement days, mandatory buy-in requirements get triggered. This adds a critical layer of chaotic potential, a possible short squeeze if the administrative process breaks down. It's proof that these events introduce risks that defy simple rational modeling. The FTD data suggests this process is not clean, it's not orderly, and it highlights real failure points in the system.
But that mandatory buy-in is there to protect the system, not break it. And the key here is the date, December 1st. That's the warrant redemption deadline. It ensures all this derivative leverage and confusion gets extinguished. The ARB window closes. The FTD should dissipate as the new shares finally get delivered. The system absorbs the shock, and then it corrects itself. The pain is intense, but the mechanism is self-correcting.
It eventually corrects, sure, but the damage is done in the meantime. The complexity created the window for exploitation, and the chaos, including the FTD risk, it just amplified the price decline beyond what pure fundamentals ever demanded.
Ultimately, I'll reiterate my point. The intense, short-term price drop is dictated by mechanical forces. It's the inevitability of dilution gravity. After December 1st, the structure cleans up, creating a clean slate for investors to refocus on the real story, the long-term mind-to-magnet thesis. The volatility was mathematical and, frankly, necessary.
And I maintain that the price collapse highlights the inherent fragility of this market structure. Where there's complexity, there's exploitation. The volatility has been driven by latency arbitrage and mass confusion. You have to understand the nuances of dark pool volume and the mechanical chaos around the warrant deadline to really get what happened here.
What we can both agree on, though, is that the central question for USAR is about to shift, and shift dramatically. After December 1st, the focus moves entirely from the technical question of what are the ARBs doing to the core fundamental risk. Can they actually build the mine? We have to study both the market mechanics and the market microstructure to appreciate the full picture.
A crucial distinction, one that often separates speculative hope from investment reality.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.